Good evening. Welcome to the Money Show. I'm Kavita Thapliyal, and this is a show where we decode markets, money, and the road ahead for investors. That's right. Specifically talking about this year, it's a year defined by sharp market movements. That's right. Sudden corrections, global political uncertainty that continues, and shifting interest rate expectations. Corporate earnings have surprised in parts, disappointed in others. Budget season is upon us. Sector leadership is rotating faster than ever, and global risk factors from geopolitics to currency volatility, which is at an all-time high and are in back focus now. So the big question as an investor is this the year to rethink portfolio strategy? Is asset allocation, not stock picking, the real key to future proofing wealth? To help us decode all of this and make sense of it all, we are joined by Srikanth Subramanian, founder of Ionic Wealth. Hi, evening, and welcome to the show. You're a seasoned market strategist, a wealth advisor. I just want to understand the kind of market phase we are experiencing right now. In so many decades of years of experience of yours, what is something new that you are witnessing for the first time?
Hi, Kavita. Glad to be on the show. As you rightly said, I think if there is one single word that picks itself out as far as the last 12 months is concerned, is volatility. And I think the only thing that gives us any kind of cover or ammunition to play and defend against this volatility is asset allocation. So first and foremost, I think what would be the most sane way to navigate these very turbulent times is to completely go back to principle 101 of wealth management, which is to have a very well diversified portfolio across various asset classes, because there is no one single winner in any asset class. And as far as what is one uniqueness that defines 2025, and I think some of that can continue as we move into 2026, is the pace at which things are changing. I think it's a very, I was joking yesterday with someone that anything and everything that we have studied as students of economics, students of finance, is getting tested. All conventional correlations between two events are getting tested. Geopolitics usually will mean that a particular currency or a particular commodity will move in a certain way, and we are seeing dramatically opposite movements there. So not only have the news flows made the cycles extremely short-lived, but we are also seeing very counter-cyclical movement to what so far has been a very correlated asset class or correlated kind of news flow-based movement. So that's how I look at how 2026 has been. And so far, I have no reason to believe if 2026 will be any different either.
All right. So, let's just take it step by step. And the current hot topic, corporate earnings, earnings pulse. How impressed are you with the quarterly earnings so far? Are we seeing broad-based strength, or is growth still concentrated in selected pockets?
Well, it's still early days. As we know that from the NSE 500 list, we're still about 20-25% of list companies that have declared their results. So I'll still sort of keep my judgment in abeyance. But of whatever little I've seen so far, I wouldn't say, let me put it this way, that we anyways were not expecting a very robust quarter given all that has happened from a impact of tariff, from a impact of the global volatility. So if I keep the reference to the context that we didn't expect this quarter to be a very big quarter for us, then we are broadly in line. But so far what I'm seeing is both the earning growth and revenue has been in single digits. So it's nothing great to write home about. But by and large, there was a feeling that you will somewhere see the next quarter being a harbinger of change, if you will. So far, whatever little we have seen, there is nothing to really be very cheerful in terms of very exceptional growth. But that wasn't to be expected either. So I just want to balance out this factual statement by setting things in context.
Right. Let's also talk about sector rotation. I just want to understand what's the theme looking like? What's the sector rotation in the markets right now that you're witnessing? Which sectors are losing leadership, and where do you see fresh momentum also building?
So I think a couple of sectors that have done well, and I think there is still steam left, which can continue to do well, is financials, and typically large private sector banks and tier one NBFCs in specific. But by and large, financials as a space has actually been quite a leader in terms of one of the key sectors. Metals, for obvious reasons, we've all seen what's happening with metals globally, both in terms of precious, industrial, and overall metal as a category. So the sector which is largely associated with metals has been doing very well, and I think there is more room there for those companies to do well. Auto and auto ancillary companies, and this is specifically more contextual to us in India post the GST boost that India got, and we've actually been seeing some demand revival there, and auto ancillary companies have been doing quite well. On the other side, sectors like capital goods, power have been finding it a little challenging to sustain meaningful growth. IT, of course, has been a hot topic, and no surprise that it's been a mixed bag, that because the expectations were not sky high, in relation to that, some of the top tier IT companies delivered results either in line or slightly better than expectation. But given the fact that expectations were so low, we have to just see that in that context. But given what's happening globally in terms of how overall AI is going to chip away at some of these conventional software companies, IT will continue to be a challenging sector, and we are witnessing IT as one of the more mixed bag kind of a sector. So that's what we are seeing, Kavita, at this point of time in terms of how some of the sectors are stacking up.
Srikanth, any specific sector you think can turn out to be a dark horse or maybe a wild card?
No, I wouldn't guess at this stage because, as I said, I would still wait for the broader results to sort of come in before I can make. But I would think that the banking or the financial services sector will continue to be the larger flywheel, given what we have seen in terms of the quality of book, and if credit offtake also sort of coincides, then I think I will continue to believe that the leader will continue to lead even as we move into 2026.
Srikanth, no portfolio conversation can be complete without talking about gold and silver. Silver ETFs saw a sharp correction, nearly 20% from recent highs. At the same time, investors still want exposure to precious metals as hedge. Now, how do you see the trajectory for silver and gold playing out, especially with the potentially unpredictable Trump presidency, pressure on the dollar, and volatile equity markets? How should one actually place themselves in precious metals? And also, now, is gold just a hedge? How do you look at it?
I think it'll be now unfair to call gold only as a hedge, because gold's almost sort of broken into a separate asset class. The spree at which central banks have been buying gold, and now, of course, silver, and I'll just dwell into silver in a bit. But in general, precious metal will now have to be accorded a separate asset class rather than having to look at it only as a safe haven, which also means that they will also be susceptible to volatilities associated with proper asset classes. They have run up quite a bit, and for many measures, not only because of the fact that it's a more predictable safe haven conventionally, but also the fact that the uncertainties relating to some of the geopolitics, the buying frenzy of most central banks to hedge themselves against a singular force, the weaker trajectory of US dollar in general, have also been equally responsible for precious metal in general to have a rally. And I think most of what I mentioned as the reasons for these precious metals to rally are still far from over. We still are staring at some not very predictable geopolitics. We still continue to believe that US dollar, for reasons best known as trade, will continue to be slightly more weaker. We do believe that central banks will continue to purchase gold more than what they have in the past. Means that the precious metal overall will continue to have legs. Now, the way we look at it is like anything where we try to sort of put more sense into it. We don't take a very big isolated call on anything. We look at it from a point of view of an overall portfolio allocation. We have a allocation of between 5 and 10% to precious metal. But what is also interesting is that between gold and silver, we recently paid down our 50 gold, 50 silver to a 75 gold, 25 silver. And that's not only from a point of view that we believe silver has run its course, etc. There is quite a possibility that both gold and silver can go up. But we also believe, and this is something which we find extremely interesting, that even in a stellar year, and by stellar I mean stellar for gold and silver, stellar year like 2025, if you remove the lens of only absolute return, which is what typically get more eyeballs rolling, people look at absolute returns and we say that they have done well. But if you add the context of risk-adjusted return, which is the right way of looking at any portfolio return, any asset class return, even in a stellar year like 2025, gold is 2x on risk-adjusted return as compared to silver. Now, for a naked eye, if you only look at return, silver is almost 2 times as high as gold or even higher. But on a risk-adjusted basis, if you take into account the volatility, if you take into account what we sometimes call a standard deviation and measure what is the kind of return you've added for every unit of risk that you've added, gold continues to be a much stronger risk-adjusted commodity. And the interesting data point is, while to make this point, I'm isolating 2025, but it has been the same whether you look at over a 3-year, 5-year, 10-year, 20-year window. And because of those reasons, we believe that return alone should not be the only barometer. Gold continues to be much less volatile as compared to silver, and hence our tilt slightly higher towards gold. And we also believe that because of, in India specifically, since the demand outweighs the existing supplies, some of the Indian ETFs also have a little bit of a premium, which is more artificial in nature, which is largely due to the demand-supply mismatch. So keeping all this in mind, at an overall level, we continue to believe that precious metals still have room and legs to grow even from here. And that's why we continue to have a 5 to 10% allocation to portfolio, of portfolio into gold and silver. But between gold and silver, we are slightly more biased towards gold on the concept of risk-adjusted return, as I just mentioned.
Absolutely. One last question, because since you have joined us and budget is around the corner, what are your expectations from the budget this year? You know, which policy signals and allocations could move markets meaningfully? And I'm asking this question with you being a market participant and also a taxpayer.
Yeah, no, I think, look, I think over the last few years, if not a decade, but maybe at least the last 3, 4, 5 years, budget has been a very responsible statement of accounts. And that's exactly how we should look at it. I think for some reason, we used to put inordinate focus and spotlight on immediate gratification for capital markets from budget. And I think over a period of time, the fiscal agents have made sure that there is a very responsible undertone. And I think even this year's budget will be no different. There will be some degree of tax relief, and this is more as not just a hope, but this is more an expectation. I think, given given our need to navigate through some of the global uncertainties, we could see some degree of easing happening. I also remain watchful to see whether it's from indirect taxes like what we saw in GST, or there is some relief in direct taxes. But I do expect that there could be some room for relief from a general stimulation point of view in India. But I'm not sort of taking a huge weightage on that. But I think the undertone of the budget is going to be on fiscal prudence, and I think we will continue to see fiscal consolidation as one of the major themes.
So I also want targeted announcements that you expect. And let me reframe this question. What if you were the finance minister? What announcements would you make?
No, look, unfortunately, that's something that I'll respectfully sort of refrain from, but I'll do. I will expect us to continue on the path of fiscal prudence, because I think one thing that India has really sort of stood up for is, irrespective of any kind of pressure, we've been clearly able to chart monetary policy, fiscal policy fairly independent when they have to, and yet at the same time never losing the broader focus for things which are essentially right for us. So I think broader tone will be of fiscal consolidation, whether the matrix is on debt to GDP, whether the spotlight is on deficit as a percentage. But I think broad messaging will be on the responsible fiscal prudence, and I do expect some relief measures more from a feel-good kind of an environment for the country to be left in.
Right. I think with that, it's a wrap. Thank you so much for taking time out and helping our viewers understand the current market trajectory. Skilling person with disability plays a critical